Got positions on in ES, MES. And I got a little bit of stuff going on in here, so some of this I'll have to explain. First, let's start with the naked puts, because those are the riskiest things. Got naked puts here in this ratio spread. This is a 2-by-1 ratio spread. It's a profitable trade though, and no danger, nothing to do. I've got a 4-by-2 ratio spread, 2-by-1, but I doubled the contracts. This is a profitable trade, almost at 50%. So we had a big up day today. You know, if the market really started moving, this might hit 50% today. Everything else is downside hedges. This is a put debit spread, way out of the money for, you know, the market crashing, and then long puts that are way out of the money, again, for the market crashing, just to help protect me in the event we get some, you know, big move down or a volatility spike. Especially these 3 long puts will help offset the vol spike. And then I've got this weird position I put on Friday in the ES. Now I've got a short put, long call, 2 more long calls. What is this thing? Let me show you. Let's go to the curve and analysis. Let me zoom way out because the ES has a million strikes, so you can see what this is. It's basically kind of like a back ratio spread, except it's more of a ladder. Instead of doubling up the long calls here, you know, I split the calls. I actually did 3 of them, so it's like a 1-by-3 back ratio spread. I sold the at the money call, and with that really high premium that I get for selling a 50 delta call, I used it to buy these out of the money long calls. What this creates is what I would call a call ladder or a bear call ladder. And what you want is, you're obviously playing for an upside move, right? It's these long calls that you're playing for the market to go up. The market goes up, I can make a lot of money. Potentially unlimited profits to the upside, obviously on the long calls. On the downside, I can't really lose because this 50 delta short call offsets the losses from the debit I paid on the long calls, so I can't really lose to the downside. The risk is this thing not moving at all and falling into this trap here, right? This little valley of death that you get on these kind of back ratio spreads, or in this case, this ladder here, is if you fall into this area, you could suffer a pretty substantial loss. I would suffer a $3,400 loss at expiration if I held this to expiration. I'm never going to hold this to expiration because that's just way too risky. I'm playing this just for this week. Right? I'm going to hold this 7 days because in 7 days, I can't get to that max loss. I won't come close to it. So I put it on at 28 days last week on Friday. I'm already at 25 days because we had 3 days pass on the weekend. Right now, am I up on the trade? Up slightly. I was up nearly $400 last night, though, when the market was up quite a bit higher. And that's what I need. I need a move up, but let's go forward in time. I'm only going to hold this to the end of the week. Let's go to August 1st. That will be Friday. You can see I still can't really suffer much of a loss in this little trough area here if I get out by Friday. So I either get the win or I could lose small. Actually, if the market really doesn't move much, chances are volatility is going to decrease a little bit over that time. A big decrease in volatility starts hurting me. It could cost me, you know, a little bit of money, a few $100. Actually, yeah, a down move would hurt me at that point with vol coming in. But realistically, I could lose a few $100 or I can make a few $100. If you look at the expiration P&L, you're dealing with thousands of dollars, obviously, on a big product like ES, but because I'm only playing it for a 1 week move, I'll make a few $100 or I'll lose a few $100. But what's interesting about this trade is backtesting it. Let's backtest this. This is what makes this interesting. Put on a new trade. Let's sell a call. Let's sell the 50 delta call. And I did this at 28 days. And then let's buy some other calls. Buy one call. I think the delta I chose on that trade that I showed you was around 37 deltas. And then I bought a couple of really cheap, like 12 delta calls, just as a kicker to the upside, just in case I really get a good up move. Those things would really pay. Oh, it's a 28-day trade. I'm only going to hold it a week, so I'm exiting at 21 DTE. And let's backtest this in SPX for the last 5 years. Take a minute for that to run. And you got to backtest SPX or SPY if you're going to test things for like the ES. Because the ES futures you can't backtest because each expiration of those futures every quarter is a different product. The pricing doesn't match. You can't really backtest the futures. You've got to do something that has a continuous contract like SPX or SPY. All right, so in this particular example, those deltas and that time, had a return on capital of about 400%, right? Basically 5 times our money over, what was the time frame we did this on? 5 years, where you'd have doubled your money holding the S&P 500, which is a great return. That's why long-term passive investing works. Just buy some SPY and sit on it. But, we're trying to do a little better. This is an interesting trade. So if you look at the details on this trade, we win about 40% of the time, 38% of the time. But here's the thing, because we're only in it a week, I already kind of showed you, you really limit your losses by only holding it a week. But on those weeks where the market really moves and those long calls really pay off, you can see that you get some big wins and, the losses are much tinier. So that's the thing. Can you handle only winning about 40% of the time, losing 60% of the time, but those 60% of the time you're losing, not losing as much as you're winning. Interesting little trade. Not something I normally would trade, so I thought I'd check it out. That's what I'm doing in ES this week. And depending on how this works out, I just want to see how this behaves in real world action. Might be a trade I play going forward, just as something to diversify a little bit. What's interesting about this kind of trade, something that is primarily a long options trade, because I've got 3 long calls versus the 1 short call. I can't really get hurt on that thing in a crash. Like so much, all my other positions. A market crash kills me on everything I have in this portfolio. I've got strangles, short puts, long shares, credit spreads, mostly put credit spreads, iron condor. A crash is just going to murder every single position I have in this portfolio. It wouldn't hurt me at all on something like this. It's a completely opposite because it's a long premium play rather than a short premium, meaning I bought options instead of selling them. So a market crash is not going to hurt me because there's no downside risk to this particular trade. Remember, I can't really lose to the downside. Also, when you get a market crash, volatility spikes. A vol spike helps long options, right? So like a August 5th type event where you get a gigantic vol spike wouldn't affect this position at all. Matter of fact, it would greatly help this position. I'd make a little money on that position. So it's nice having something that's a little different in the portfolio, where, you get those kind of dark days, like we had the market meltdown this year, February and March. Stuff like this would have been fine through that, where, some of those like ratio spreads that I have on in MES are going to get murdered, in a big down move. So it's just, a different way to put on some trades that can't really get hurt too bad.